Welcome guys. Today we're going to do textbook exercise 8.3, which you'll find in your textbook on page 173 and your workbook on page 148. So as always, make sure you've got both open if you're following on. And 8.3 asks us to work on a return to supplier. So we're asking ourselves, how do we record in our general journal and general ledger a return to supplier? So let's read through the question. We're going to go through this one relatively slowly. So if you're feeling really confident, you might skip through a little bit of it, and that's okay. So let's read through it. And we'll highlight the bits that might be important. So on the 1st of July, the dates are always important, Azo Party Auto Spares purchases inventory from Chrysler Australia on credit. So on credit is always important. That will be relevant later, for $2,000 plus GST of $200. So we will record that transaction in a second, even though it's not actually part of the question, just so we're really clear. The important bit here is that some of the goods were the wrong specification. So let's highlight that. That was the reason why. What do we mean by wrong specification? We've clearly ordered some inventory and they've given us the wrong type or size or something like that. And understandably, Azo Party returns them to Chrysler on the 3rd of July. So we purchased them on the 1st of July on credit and we return them on the 3rd of July. A credit note is sent, credit note number 65, that will be relevant information, is sent to his business. So you remember from your understanding of source documents and particular credit notes, the business that is receiving the returned inventory, so the one that is getting the inventory returned, the business that made the mistake is going to create the source document. And you remember a credit note is a source document that recognizes the mistake and credits, so accepts the return and removes the bill required because of that inventory. It is sent to Azo Party, and the goods originally cost Azo Party $150 plus GST of $15. He intends to sell these items for $290 plus GST of $29. Now you will see that I've not highlighted that because that is important. It's important because when we don't care about that, because what's the key part about inventory? We recorded at cost price, not selling price. So let's just cross that out. That has nothing to do with what we're going to be doing in this question. So what are we asked to do here? We're asked to prepare the journal entry for the return of the goods by Azo Party. And who are we doing this for? We are doing this as Azo Party. So we are doing this return as if we're Azo Party. So we are returning goods to our supplier. So it is a purchase return. We're then going to be asked to prepare the general ledger account for Chrysler Australia, showing all the entries for July, and then work out how much we as Azo Party owe to Chrysler Australia. So there's a lot going on in this question. Let's take a step back and pause and make sure we're all on the same page on our debits and credits, because we're going to have to think through our debits and credits really hard for this question. We don't need our textbook open to understand debits and credits. All we need is Paler and an understanding of our increases and decreases. So if we have Paler, remembering A equals assets, L equals liabilities, E equals expense, R equals revenue, P equals proprietorship, which is capital. And if we understand that an increase of an asset is a debit, and I think that's always the easiest one to remember, but it doesn't matter which one you remember, we then fill in the gaps with a pattern of credit, debit, credit, debit, credit. And then if an increase in an asset is a debit, then a decrease must be a credit, and we continue on with our pattern. This will be our cheat sheet for the rest of this question. We're going to do some parts that aren't asked here, just so we really understand how to do a purchase return. So, part A asks us to prepare the journal entry to record the return of goods by as a party on the 3rd of July. But that is not the first general journal transaction here. Because on the 1st of July, we actually purchased some inventory on credit. And this would be recorded in our general journal as well. So let's think this through. What happened on the 1st of July? We received inventory from Chrysler Australia. Our inventory has hence increased. Inventory increasing is an asset. So an asset increasing is a debit. So we would do this as a debit. So on 1 July, we would actually have a general journal transaction of inventory increasing. And how much was our inventory? $2,000. We've also got here some GST on this transaction. And remember, GST clearing is our general ledger account. Because you remember, the accounts that you write in your general journal are just the ledger names. Have we received or paid GST here? We have paid GST, and that actually reduces how much we owe to the government. We think of GST clearing always as a liability. So inventory is an asset that has increased. GST clearing is a liability that has decreased because it's reduced how much we owe to the government. And we look at paler down the bottom, and a liability decreasing is also a debit of $200. What is the other side of this transaction? We purchased this inventory on credit. That means we have an accounts payable, and that accounts payable would be for Chrysler. And how much do we owe them in total? $2,200. So that would be the 1st of July transaction, and we're going to jump around a little bit. You can see that in B, we're required to prepare the general ledger account for accounts payable Chrysler Australia for all the entries that happened in July. Did this transaction that we just did occur in July? Absolutely, it was on the 1st of July. So we have actually something to record in our general journal here. We have a credit to accounts payable Chrysler. Remembering, what does a credit actually mean in our general ledger? All it means is the right-hand side. Credit equals right, debit equals left. So we have to record on the 1st of July, $2,200 on the right-hand side of our accounts payable Chrysler ledger, which we're doing. And what's the cross-reference? All the debits that equal 2,200, and you can see there are two of them. So our cross-reference is inventory, GST clearing. So while Part A doesn't ask you to record that, it is important that you understand that there was a general journal transaction that occurred on the 1st of July that we had to record. Let's now think about how we would actually record the return of the goods on the 3rd of July. So what do? We are essentially doing nothing more than reversing a part of that transaction. We owe Chrysler Australia $2,200, and it's clear that we weren't happy with some of it. We weren't happy with some of that inventory. We're not going to pay something for something that we're not happy for, and that's been accepted by Chrysler Australia. They've sent us a credit note saying that $150 plus GST is now no longer required to be paid. This means our accounts payable is less by how much? $165. What happens when our accounts payable goes down? Our accounts payable is a liability. Liabilities going down is a debit. So we would record this on the 3rd of July, accounts payable, Chrysler, and I am running out a bit of space, and that's okay. $165 we owe less to Chrysler. We obviously have to, if we do a debit, have our credits as well. What has also happened here? Our inventory has gone down. Asset going down, as you can see by Paler, is a credit. How much did our inventory go down? $150. We've returned $150 worth of cost price value of inventory. And in a way, we now owe $15 more of GST to the government, because the GST that we originally paid has been returned to us or been credited. We now have a general journal transaction that balances. And what does this mean? We've reversed our accounts payable transaction. We owe Chrysler Australia $165 less because we have sent something back because we're unhappy with it. That return meant we returned that inventory, which means we have $150 less of inventory in our business, and we have $15 more of GST owed to the government because we've reversed the reduction of GST that we recorded on the 1st of July. Part A says nothing about that we don't have to do a narration, so let's assume we do. What would be a perfect narration? We're telling the story of the transaction, something along the lines of return of goods to supplier and explaining why. This was due to the wrong specification of the inventory, so they gave us the wrong type of inventory. And really importantly, you would never get the mark for the narration unless you write the source document, credit note 65 in this case. And just like you've seen in here, if you run out of space, don't worry about, never abbreviate. If you run out of space, you can always make it clear to your teacher or the examiner, but never abbreviate anything there. We now can move, so we've now can tick off a perfectly answered question for A. We've prepared the journal entry to record the return of goods. We also have done one part of B, which is prepare the general ledger account for Chrysler Australia, but we now have something else to record because we've now got a debit of 165 for accounts payable Chrysler, and we know debits are left. So 165 on the 3rd of July now to recognise that we owe Chrysler Australia $165 less. And our cross-reference here is the same as our previous credit. Inventory and GST clearing. Why? Because in this case, our credits that add up to 165 are inventory and GST clearing because we're reversing a portion of the original transaction. So we have now done part of B, and it's a bit of a trick question. We need to prepare the general ledger showing all entries for July. And what do we do every month in our liability accounts, which accounts payable is. At the end of each month, we have a balance date and we need to balance this account. How do we balance the account? We add up both sides and write the biggest on both sides. What's our biggest number here? $2,200. And then we need to balance it. We need to actually make this $165 plus something equal the 2,200. What is that number that means that something equals 2,200? 2,035. We have done a debit, so we need to have a date. It's the end of the month, and our cross-reference here is balance. We've done a debit, which means we must do a credit. On the first day of the next month, on the 1st of August, our balance is 2,035. We have now done all the general ledger postings for Chrysler Australia. We have recorded the two transactions and also balanced the account. C is actually the easiest question of all. State the balance owing to Chrysler Australia at the 31st of July. What does that mean? How much money do we owe Chrysler Australia on the 31st of July? We've worked it out. The 31st of July is the same balance as the 1st of August. We owe $2,035 to Chrysler Australia. If we think this through, this is pretty obvious. We owed them $2,200 and we returned $165. That equals $2,035. And guys, that was how we record a relatively straightforward purchase return or return to supplier. What's key to remember here? You think about the original transaction that increased accounts payable, and a return is reversing a portion or all of that transaction. So we're going to owe less of accounts payable and have less inventory and have more owing in GST. What do you need to make sure in terms of tricks? The credit note is going to be written by the supplier, and they are going to tell you how much the cost price is. We don't use FIFO, we don't use identified cost here. We are told in the credit note how much our cost price is, and if you're asked to do any recording in an inventory card or anything like that, that is the price that you're going to do in your out column because inventory has left your business. Good luck with the rest of this chapter in terms of doing returns to suppliers or purchase returns. Our next thing to do will be sales returns, which I will do in the next video.